In today's video, we're going to go over the EMA and how to use it properly to make a lot of profit in the markets. I have a specific 3-step process that I use, and I've developed this over years and hundreds of hours of backtesting the EMA. In the second half of the video, I'm going to have 5 or 6 real-life examples. Some of them worked, some of them didn't, so you can understand the nuances of the EMA, how to use it, when to use it, and when not to use it. This is a very important video and a very important concept, because it's actually one of the only indicators that I use. I'm a very price action heavy trader, and the 50 EMA plays a crucial part and a crucial role in the strategy that I trade. It means that it is in fact effective. I've actually heard of the biggest traders in the world using the same EMA that I use, and I'm talking about traders with hundreds of millions of dollars. I found that the best EMA to use is the 50 EMA. So just set the length to 50, and when it asks for the source, just put close, length 50. You can find this indicator on TradingView by just putting EMA. Don't choose SMA, that's smooth moving average. Do the exponential moving average. So the EMA set to 50 is going to give you the same EMA that I use for all of my trades. So now that we got the setting out of the way, let's get straight into the sauce. So how will we actually use the 50 EMA? Like I said, there is 3 main steps. I mostly trade the EMA on the 1 hour time frame, sometimes the 2 hour, and very rarely I'll enter in on the EMA from the 4 hour time frame. But it can still be useful on the 4 hour. Let's break down how I actually use it in the 3 main ways. The first main way and the first step is use the EMA to spot the bounces in the market. So the first way that I use it is for bounces. On the 1 hour or the 2 hour time frame, when the price approaches the 50 EMA, a lot of the time it's going to use it as a dynamic support or resistance. You would be surprised at how often this works. Kind of how you see right here at the bottom of the screen. This happens over and over again. It's just how the market moves. It almost seems like the market was built around the 50 EMA. If you know how to find it and if you know how to use it, it can help you out a lot. Because if the trend is up and price touches the 50 EMA, then I'm just going to simply look for a bounce off of it like you see down here, and then just buy and catch the movement to the upside. If the trend is down, so the opposite of this, and it hits the EMA from below, so it goes up into the EMA, then I look for a short position. The key here is actually waiting for it. This is what 99% of traders get wrong. They understand how the market bounces off of the EMA, but they don't have the patience to wait until a clear bounce signal occurs to then enter in the trade. The second step is determining the direction. This is also one of the main benefits of using an EMA like the 50 EMA. It helps me read the direction of the market. If the EMA is pointed up, I know the market is most likely bullish. If it's going downwards, then the market is bearish. Now, the reason why this is so cool for me is because it's objective. There is no emotions. There is no, oh, I see it bullish, but you see it bearish, and then that trader sees it consolidating. The EMA is either pointed up or it's pointed down. There is no in between. And if the EMA is pointed up, it is objectively bullish. Vice versa for bearish. This is crucial because it tells me which trades have higher probability. I don't ever fight the EMA, and I only look for setups that align with the direction of the EMA. All right, so we got direction out of the way. So now let's get into the third and final step, which is shift of structure. This is one of the reasons also why I love the EMA so much. If you see this image down here, you'll see that this market was bullish and then it shifted into a bearish market. Look how the EMA goes from pointed upwards to the second that this move down happens, it's pointed downwards. That's objective. That can objectively show you that the market is going in the opposite direction. Now, it doesn't necessarily mean it's going to continue down. There are other factors that you need to add in to confirm that direction shift, but it's a very good indication, because when price starts closing below an upwards pointed EMA, there's a high chance that the trend is changing, or there's at least going to be a pullback. Doesn't necessarily mean it's going to completely reverse. A lot of times it will, but it'll at least show you that a pullback is starting to form. Similarly, in a downtrend, a close above the EMA can indicate a possible reversal. So this can help you out a lot, because if you're in a buy and then the market starts to point downwards on the EMA, you might consider closing out of that buy position, especially if it's on your entry time frame, which in this case, we're using the 1 hour, 2 hour, so it's going to be on your entry time frame. This gives me a head up before the market fully flips, and it helps me manage risk and position size. All right, now let's get into the examples. So I'm going to show you 5 or 6 hand-picked examples of real life market situations. Some have worked, some haven't worked, and some are shift of structures, some are trending markets. You're going to see now in the markets how this actually plays out. Let's say, for example, you're looking at the concept of an EMA, and someone says that the EMA is always going to be used perfectly as dynamic support or resistance. But then you go onto the chart and you see it not tap into it and miss it by a couple of pips. Those are the things that no one talks about. Those are the nuances that people leave out of their courses, of their videos. People don't talk about the fact that price will get close to the EMA, but it won't actually tap it. But you can still use all of these as extra confirmations for your trade. That's how we use it better than anyone else. So let's actually get into the concepts and into the charts. All right, so I got the first example pulled out here for you guys. It's on GBP JPY. The first thing that I want you guys to see is that this is a market that was bearish. So if we look here to the left, we'll see that the market held this as an area of resistance, and it also held it as a dynamic resistance right off of that 50 EMA. So the fact that the market was going down and actually had a bearish market structure, forming lower lows and of course lower highs right off of that EMA, it shows you that this is a bearish market. But then look what happened. The market shifted, and we can see that with price action. But what else can we see that with? We can see that straight up in the fact that this EMA shifted to the upside. So I'm going to put it in a different color. Let's put it in yellow. If you look here at the yellow circle, you'll see how the EMA alone, you don't even have to look at the price. You could just look at the EMA. Let's see if I can hide the candles. Notice that shift and that rapid shift of where the EMA is going. That is what helps you identify the market structure shifting as well. So you're combining a concept like market structure with something like a 50 EMA, and it's coming together perfectly. So now that you see that it's going upwards, you can simply just look for a bounce off of the EMA. And right here, literally the market just came up, bounce into the EMA. You can take your buy position off of that bounce. You place your stop loss somewhere below the EMA. So you're also using it as support, which means anywhere that your stop loss is below the EMA should be pretty safe as long as it continues to hold. So this was a very, very nice example of a market structure shift. You can see with the EMA how it starts to point straight upwards after pointing down. So next, let's go on to an example here on GBP USD. Now this one I just pointed out because this is one where a lot of people would look at this and say, look, this is an example of when the EMA didn't play out. What the hell, Brian? I thought you said this would play out all the time. Well, no, it's not going to play out all the time, because there are other factors in the market, and sometimes the EMA will just break. Now, in this case, we do have a reason why this didn't play out. So right around 3 a.m. Eastern time, we had major high impact news for the British pound, and that's what made this movement down right here. Sometimes it's just not going to work. Like, let's say, for example, here, right? You can say that it wasn't that strong of a trend, and that's why it didn't work, and that's why it doesn't fit the criteria. But let's just say you did want to take this trade. It wouldn't have played out because the market just simply broke below. But as you see, for the most part, the market is going to hold. And that's why I have a bunch of examples for you guys. And you can also go out and backtest this and see just how effective it really is. So let's go into NZD CAD. This right here is a very, very interesting example because it's also an example of a market structure shift. So as you see right here, we were in a bearish market and then we simply just shifted into a bullish market right here. And the EMA shows us that. The EMA kind of makes this pattern of a U. So when it does a U pattern, if you see the EMA do this, that is a typical reversal pattern. And you just want to inverse it if you're doing the opposite, right? So if you're going on a bullish trend, let's say the market is going bullish and then it starts going bearish, and you see this EMA pattern right here, you know that that is a reversal pattern. So right here, the market bounces right off of that EMA, right at 0.81450, then continues to go bullish and continues to respect that 50 EMA. Although here it did not tap into it, it got extremely close. The market stayed actually respecting it as support even after lower highs were starting to form, until finally the bearishness was too much and the market had to break below that 50 EMA. But the beautiful part about this is that you have so many hints that the market is going to basically reject and start to go the opposite way. As you see right here, you had a lot of signs that the market was starting to slow down and then it was going to start trading below for continuing higher and having a shift to the downside. And even when we shifted to the downside, we're still holding it as resistance for the most part. So you can see that this is a dynamic support and resistance, and it can be used a lot of the times, honestly. So this is another very interesting example here on AUD USD, because here we have two things to look at. Let's focus on the first one. Here we have a market structure shift. Obviously, this is a huge move up. That could have been news, could have been something else. But the point is, look at the EMA, right? So you see this candle form. And let's just say you don't want to look at the price action because maybe it confuses you. You're only looking at the EMA. Just the EMA alone will tell you a big story of what has just happened. We've shifted to the upside. And if you see here, where did the market go? It continued and continued to the upside all this way. So we're talking about a big movement up. Even if you just measure from the top of this movement right here, I guess the top would be at the end of the candle, still moved 64 pips, which for an Australian pair is a lot. Now, the second part that we want to focus on here is the fact that we almost tapped it on the 1 hour time frame. So if you look at this blue circle, that's the space between where the market went, where the candles actually closed off of, and then where the moving average was. There's a huge gap between where the candles and where the wicks touched, and then where the actual moving average was. And this is something that's going to happen a lot in the market, where you basically have it come close, but it doesn't actually tap into it. So it doesn't actually tap into it. And this is important because this is where a lot of people will say it didn't tap into it. But for me, it did, because it got so close. And it's still respecting it. For me, all this simply means is that if we just go down a time frame, if I go down to the 30-minute time frame, you'll see it tap it every single time. So it's really nothing to worry about at all if it keeps respecting it in a predictable way. So it has to be predictable. Okay, on the 30-minute it didn't, but if I go down onto the 15-minute, then we'll see it respected it beautifully. This happens sometimes because the market will move in a stronger trend. If it has a stronger trend, then every 15-minute low will hit the moving average instead of every 1 hour low. It's just a faster trend, and that's why it's not tapping into it directly, but it's still respecting that 50 moving average. This is a very important key nuance for you guys to understand here, because you can't be too precise, you can't be too strict and too tight on what you consider a tap and what you don't consider it, because if not, then you will never be able to use it. So let's take a look at the Euro JPY example that I pulled out here for you. This is a really nice example because the market had already been bullish for a bit. So you see we made that first leg up, we made that first rejection off the moving average, and then we continue to go upwards. And then this is where you can catch your entry, because the market is bullish, it's trending, it's showing you rejections right off of the moving average, and you can simply just enter in and continue that bullish trend on the 1 hour time frame. This is a really nice example. I think this example speaks for itself. And I think if you can start to train your eyes on watching for these patterns, then you're going to start to see them more and more often. I have a whole section in my course where I tell my students to do 5 to 10 back tests based on just this specific pattern. And by the end of it, they end up doing like 20, 30, 40 examples, and they become beasts at identifying EMA taps. And then it becomes another tool that they can just pull out whenever they need it. And it just helps them have more, I guess, ammunition in their arsenal. Because what that means is you'll be able to spot more trades and more clean setups, and also add more confluences to your setups. What does that lead to? It leads to you being able to risk more money per trade, ultimately making more. Because I can risk 6,000 on a trade that has an EMA bounce, but if it doesn't have that EMA bounce, maybe I'll only risk 4,000 or 2,000 because I'm not as confident. So the more tools you can add to your arsenal, the more confident you can become, and the more money you can risk per per trade. That's why these things like the 50 EMA, they seem small, but these are critical, not because you need them, but because of what they add to your strategy. You don't need to trade with this, but it adds so much confidence that you just end up making more money. So let's take a look at this example, which is an example that's on a 2-hour time frame, because right now I'm on the 1 hour and you can see that the market was below it. So that's very scary, right? If you're looking at the 1 hour, you see the market going below it and you're like, oh, damn, this is going to go down, right? Like this is not respecting the 50 moving average. But if you actually just switch over to the 2 hour, you'll see that it's respecting it perfectly. And all you had to do is just get a different perspective. So here on the 2-hour time frame, you have a nice clean bounce right off of that EMA, and then the market continues to go bullish just as expected. So some markets will move slower and some trends are slower than other trends. It's not just about the market itself, it's more about the strength of the trend. If a trend is moving really fast, then it's going to be respecting that 15-minute to 30-minute moving average. Those I don't trade. But if it's a more medium to slow based trend, which for me, I love those trends because I'm swing trading, then those will hold on the 1 hour, the 2 hour, and rarely sometimes it will hold on the 4 hour. But that 1 hour and that 2 hour is the sweet spot for swing trading, not position trading where you're holding for weeks, just swing trading where you're holding for a couple of days. This is the sweet spot. So I want you guys to go out there and actually test this for yourself. Don't just watch these examples. Go find 5 examples on your own and let me know in the comments below how it went for you. Were those 5 examples winners? How many losers? Do you think that this can help you in your trading? Let me know in the comments below. I know it definitely can. And I will see you in the next video.